Colm, good morning.
Good morning, James.
Thank you very much for doing this. As I said before, we had Oliver on before, but I think that was a while ago. So I'm going to get you, if you don't mind, just sort of rehash the story on ICG Enterprise. And just introduce what the fund's doing and what it's trying to achieve, please.
Absolutely. Okay, well, listen, thank you very much, James, for the opportunity. And we always like the opportunity to tell our story and also just to tell the story a little bit about the sector as a whole. So maybe just to start, maybe just to set the scene on the sector with the next slide. I'm just going to take the audience through a handful of slides, just as I say, just to set the scene, and then we can go on to some Q&A. So listed private equity. I suppose, first of all, let's talk a little bit about private equity itself. Private equity, for many of the world's largest investors, the most sort of unconstrained, if you like, by resources, the largest sovereign wealth funds, largest global pension schemes, lots of them have been increasing their allocation to this asset class. And there's various different reasons, not least of which is expectations around performance, which you can see on the chart here, where both global and US buyouts are expected to outperform most asset classes, according to a BlackRock survey. A lot of investors like the model. They like the active ownership. It's a very aligned structure between the owners of a business and the people who manage and operate it. We've said on the slide here, it's no longer alternative. What we mean by that is it's grown markedly. So since the global financial crisis, the private equity market has tripled in size, also reflecting its attractiveness to the world's largest investors. Now, there's an issue with it, and that is that it's quite difficult to access for a regular investor unless you happen to be incredibly well off. Why is that? Minimum commitment sizes to funds. There's a huge administrative burden. Things like tax reporting is very complicated. You've got to manage cash. And it's also very difficult to access the very best managers. And that's where listed private equity comes in, allowing retail investors and small institutional investors access to this attractive asset class. And we think that listed private equity actually has a few additional benefits as well. Investors coming into listed private equity vehicles typically benefit from a mature portfolio. In contrast to those who start investing in funds, you're not waiting around for a long time for your money to be deployed. And also you've got visibility over the constituency of that portfolio and some of its features. We also think the closed-ended structure, we've just obviously been talking in that context about some of your earlier stories. We think for a relatively illiquid asset class, the closed-ended structure is obviously very well suited to managing, especially during periods of volatility. But now to tell you a little bit more about ICG Enterprise and how we address the market and how we think we're differentiated. I think just to divide it up really into three different things. We think our platform's differentiated, the way we structure our team is differentiated, and we think we have a differentiated strategy. We are the oldest listed private equity vehicle, so formed in 1981. It was formed originally with around 20 million pounds. We haven't really been back to the market at all since, and that's grown over time to well over £1 billion, so at portfolio of about 1.4 billion. Just moving on now to discuss a little bit about our team. Actually, before that, I'll just say a few words about the platform. We are part of ICG PLC, which some of you will be familiar with. It's a large alternatives asset manager with over $70 billion of assets under management. We have a global reach. We have access to lots of different institutional knowledge. We benefit from being locals in lots of different markets, and that really helps our business and our investment strategy. Just moving on to the team on the next slide. I think one of the other things that is differentiated about our offering is that we've invested heavily in a dedicated team. Myself, Oliver, Lisa form the IC. We are devoted to ICG Enterprise Trust, and you see my other three colleagues there who are also part of the investment team. But we We also benefit from, as I say, talking about the platform, that the wider support from within ICG, access to significant institutional knowledge and bandwidth and resources, which informs our decision-making, helps our operations, and we believe ultimately feeds through into strong investment returns. We're a very experienced team. Our investment committee has over 20 years private equity experience. We've a broad-based experience across both direct and fund investments, and different professional backgrounds. So Oliver started management consultancy. I originally trained as an accountant. So we've got various different skills within the team, and we bring all those different perspectives to our decision making. Now, to just focus a little bit on strategy, the thing I always like to say to people is, I think sometimes people tend to think about private equity investing as a sort of homogenous approach. But just like public market investing, there's lots of different ways to address the market. And we've just seen, for example, how Chrysalis invest in private assets. What we do is quite different. We're very focused on buyouts. So that's investing in companies typically that are EBITDA positive, cash generative, typically in mature markets, mature business models, rather than investing in more speculative asset classes like venture capital or growth equity. So we don't think there's anything wrong with investing in venture capital, but it's just we like the focus due to our very sort of risk, focus on risk-adjusted returns. We only invest in developed private equity markets. That's typically Western Europe and the United States. We find those markets, they're more mature. They have a better private equity infrastructure. So things like legal systems work better for the asset class. But also, as we're manager-led, what we tend to find is it tends to be where you get the strongest and most experienced managers. Within that market, we focus on mid-market and larger deals. Again, you'll hear some of our peers, they prefer to go for more kind of early stage, first-time funds, slightly more esoteric strategies. We actually think that there's tremendous value in the more mature part of the market, investing with managers that have experience of managing through cycles. So very often we're asked, for example, about current interest rate environment. We take confidence from investing in managers who have been through this before, who have a kind of muscle memory about how to behave during crises and know what to do. We also think that the kinds of companies we ultimately end up investing in, they tend to have more resilient business models, tends to attract stronger management teams, and ultimately, we believe, delivers a optimal risk-adjusted return profile. Related to that is a focus on partnering with top-tier managers. So again, it's very easy to be seduced by new managers who haven't been through crises. Sometimes we actually quite like managers who've made mistakes. We take comfort from the fact that they have learned from them, as opposed to backing people who've almost never been through a difficult environment. Typically, our managers have been around multiple cycles. A lot of them are kind of brand names within our industry. And we tend to back those that are relatively difficult to access, the leading managers, both in the US and Europe. And then within that quite focused universe, finally, the one of the sort of overarching theme in all of the strategies and companies we seek to invest in is the concept of defensive growth. And essentially, that is backing companies and strategies which are able to grow even during difficult and volatile economic environments. That's typically companies that benefit from long-term trends that aren't correlated with fluctuations in GDP. And we'll go on in a second to give you some examples, some real-world examples. The next slide shows you an overview of what that strategy has produced in terms of our portfolio composition. Just a few things to draw your attention to. It's a pretty balanced geographical exposure between our core markets, between North America and Europe. That's a bit of a change over the last 5-6 years. Historically, we were predominantly Europe focused. We decided to use the ICG network to expand to the US, and that's been very successful in terms of being able to access the best managers and in terms of growing, in terms of being accretive to our investment returns. We've got a balanced sector exposure. As you'll see in a second, the way we structure the portfolio means that within these sectors, we've diligenced companies. So when people see, for example, that our larger sectors are things like TMT, technology, it's obviously been subject to some scrutiny recently, but we're investing in a very different type of technology to many other vehicles you might be familiar with. So these companies are typically all cash generative. They have high margins. They're relatively mature. So there's still technology and there's still growth, but it's underpinned by a very resilient business model. Similarly, sectors like consumer, within the sectors, we've got relatively high concentration in certain companies, which we've diligenced, and we focus on the very defensive subsegments of those sectors. So technology are mature companies that are cash generative, as opposed to investing in more speculative revenue multiple type companies. Similarly, within the consumer sector, we're focused on companies that have very defensive attributes. So you won't see very much in the way of sort of highly cyclical consumer companies. And then on the portfolio construction, which I think is where we like to differentiate relative to many of our peers, in the world of listed private equity, you have some vehicles that are very concentrated, and they're concentrated not just by single companies, but also sometimes by sector. And then you've got very, very diversified portfolio construction as well. So effectively, where some of our peers are, again, nothing wrong with this, it's just a different way of approaching it, but they're more like indices of the private equity market, where individual company performance doesn't make much of a difference. We sit in between. So what we have, our top 10 companies are about 20% of our portfolio, top 30 is about just a little under 40%, top 50 a little under 50%. And that, of course, ebbs and flows as things are acquired and realized. The way we think about this is the performance of our largest exposures, which you can see on the chart here. It makes a difference to our overall NAV performance, but we're not taking what we would consider to be excessive single company or single sector risk. So it's a very balanced approach to risk management. Just moving on to the next slide, just wanted to spend some time just putting that defensive growth focus into context. And what are we looking for in these top companies? And many of them, I always think, they're reassuringly, they're boring, but they grow. We look for companies that have strong market positions. So, some of these businesses, like we just had a partial realization of IRI, effectively operates in a global duopoly. Or we've recently acquired deal QuotedData Connector. That's the 6th biggest player globally in its sector, which is consumer experience, so helping companies interface with their customers. So companies that have these strong market positions are attractive to us. Similarly, businesses with mission critical services. So we like a lot of these companies where they are critical to their customers, but very often they're not a significant proportion of the cost base. So businesses like Minimax, it supplies fire protection components. Well, those things are mandated by law and regulation. So if you think about, for example, a large airport, irrespective of the volume of flights, we saw this during COVID when airports were operating at a fraction of their normal capacity, but their fire protection systems still needed to be serviced, maintained, and replaced. So that's a really good example of a business doing something which is mission critical, but also where its technical competency, its ability to innovate is critically important. We like companies that have the ability to pass on price increases. So sometimes that's through a structural feature. So their contracts are index linked, for example, or it's because of the demand profile within the particular market sector in which they operate. So for example, we'll talk in a second about Endeavour Schools, a recent realization. Obviously, it's a schools business. You won't be surprised to learn its largest cost is labor. So it saw an increase in its cost base, but it was able to pass that on because of the underlying strength of demand, the inelasticity of demand for its services. And then we also like companies that have structurally high margins. So you see here a number of software businesses, payments businesses. So companies which are able, which have the ability to take high margins, and that obviously provides significant buffer if their cost base is moving around. So that just gives you a little sort of flavor of the kind of characteristics in obviously very high level, but the kind of characteristics of the companies that we seek to invest in. And the performance of these companies, you can see here, we're aiming for growth, but we're also aiming for consistency. And you can see that track record of our top 30 companies over at various different year ends and our recent half year. And what you can see here is that we are much less volatile than the FTSE All-Share constituents. Some years they fall very heavily, they rise, correspondingly they rise the next year, whereas our performance is much more steady and consistent. But as you can see, the recent growth has been very strong, with our top 30 EBITDA growing 26% over the last 12 months. And that represents a really strong bounce back from the COVID pandemic. And actually we saw the strength of the model even during the COVID pandemic, when obviously it was an unprecedented time of volatility. Nevertheless, the companies continued to grow. And what we also saw was some of those companies that were particularly challenged because of that private equity model, because of that active management style, they were able to weather the crisis and emerge stronger. And that's a really good segue into the next slide. We like good news. And Endeavour Schools, second largest portfolio company at October. It was realized a few days after our, it was realized a few weeks ago. Endeavour it's a fantastic case study of what we look for, and I think more generally for private equity. So Endeavour is a schools business. One of the things I love about it is it's pretty easy to explain because I think pretty much all of us have been to a school. It focuses on early years education, in particular Montessori education, but also what we would call in the UK primary schools, in the US elementary schools. And the thesis here is very much centered around identifying an attractive industry. So it has some of those very attractive demand features, which we've just discussed, but also one that's very fragmented. So it's mostly single sites at the moment in the US, but actually there's an increasing advantage to schools grouping together. Certainly I'm in my 40s and schools now are very different. They've much different sort of demands in terms of things like IT, cybersecurity. It's a very different world, and there are greater advantages to pooling together. So Endeavour was seeking to address a fragmented market. It started off with a little over 30 sites. It says on the slide 60. It's actually now grown to over 90 schools in the last few weeks through some acquisitions. It's broadened its geographical footprint across the US, and our manager Leeds, who had experience in this sector, grew it to a size where it became very attractive to an acquirer who wanted, a private equity acquirer who wanted to take the platform and grow it still further. We made a very strong return from this investment. It's been a very good result for us, and it's, I think, a really good exemplar of what we mean by defensive growth. And also the importance of backing managers, in this case, a manager you've probably never heard of, Leeds Equity, which has especially strong domain expertise. I'd also like to give you a little case study of a newer investment. This may be familiar to some of you, actually, in that some of its brands are quite popular with British consumers, with British tourists to France. So the Eurocamp brand in particular is very well known. This is an investment in a business called European Camping Group. It pretty much does exactly what it says on the tin. It operates holiday parks, camping sites. And I think it's, again, a reminder of a number of the themes I've already addressed. It was a very strong recovery from the COVID pandemic. As you can imagine, during the height of the pandemic, most of these facilities were closed. But we took comfort in investing alongside a manager, PAI, which had considerable sector experience. Any of you who've owned our shares or followed us in the past will remember a very successful investment in Roompot, which is a quite similar business, which operated in the Netherlands. That was actually realized in 2020, just right in the middle of the pandemic, when everything was closed up. These businesses, as I say, PAI have tremendous experience managing these businesses. It's also something where, again, the ICG footprint was very helpful to us. ICG's direct investment team used to manage a similar business in the UK. And that was really helpful to get us up the curve to help us understand the industry. So a combination of that ICG knowledge and backing a manager in PAI who really understood the sector made this particularly attractive to us. It's a very resilient market. Very often, even in times of recession, people still want to go on holiday and will often look for a better value alternative to their traditional holiday. And sometimes that can be camping or they're very well run, very attractively situated holiday parks. And there's lots of drivers for growth. So just like with Endeavour, it's a very fragmented industry, so there's significant potential for M&A. And actually, the manager has just executed a very significant add-on, and it's also trade. We understand it's trading very well at the moment. There's been a really strong recovery in travel, so it's a business that we're a relatively new investment, but one that we're very optimistic about its future trajectory. I think just to sort of finish off my initial introduction, I just wanted to obviously touch on one of the most important things for shareholders and potential shareholders, which is returns. So as you can see, based on our most recently released results, we've generated over the last 12 months portfolio return of a little under 14%. That's in local currency. And you take account of currency and some of the other balance sheet activity, that brings you to a NAV per share total return growth of a little under 20%. And over the 5-year period, these numbers, by the way, are annualized. You can see the portfolio grew an average of 20%, and that resulted in NAV per share growth of 17.6%. But one of the things we're most proud of is not just the headline numbers, which we think compare well, but it's the way in which we've generated those returns in a very consistent way. So you can see in the chart on the right that historically NAV has grown in most quarters. You can only see there's 2 periods where it contracted, one of which was really in the height of the COVID pandemic, the first quarter of 2020. But it's been a very consistent growth pattern. And that reflects, the way our strategy works. So we're really looking for, as I say, that defensive growth strategy gives you that profile. It's also those returns have been supported by a progressive dividend policy. So we have a long track record over the last 5 years of increasing the dividend, and also through a recently launched share buyback program as well. And finally, the final slide just gives you a summary. I won't go through all these numbers, but the performance over the last 5 years, various different time periods. And you can see that the performance against the listed markets in particular has been especially strong in terms of NAV per share. There has been, of course, some noise over the last few months with our discount, which has impacted our share price total return. But we think that as we look to the future, we think the portfolio is in good shape. As I say, we've been very focused on building a defensive portfolio, and it's one which, based on recent track record, has been growing strongly. And so we look forward to seeing what the future brings. And I think with that, it's probably a good time to go on to questions, James.